Welcome to the German Climate Pavilion at COP28 in Dubai. Ambitious, just together.
Hello everybody, good afternoon. Thank you so much for attending and for making time in your calendars here at COP28 in Dubai. Also, thank you for joining us virtually, dear audience in our live stream. It's a great pleasure to have you with us here in the German Climate Pavilion. It's great to see you. So now the next hot hour will be, of course, about the hot topic of the role of the insurance sector in climate adaptation. And we're going to have a deep dive into that topic, a panel with participants from different sectors. We have guests from the insurance sector to discuss how insurance companies can really contribute to the climate adaptation. As we all know, climate change is a global challenge posing material risks to society, but also, of course, to the economy. And its consequences are becoming more and more, not just visible, but also apparent, particularly when we talk about the physical risk exposures and when we look into the increasing frequency of natural disasters, such as floods, droughts, and wildfires. And just recently, when we look into Europe, and I'm sure our panelists that will join us later virtually from the European Insurance and Occupational Pension Authority, she will have more facts about that figure, because the dashboard on insurance protection gap for natural catastrophes shows that currently only a quarter of the total economic losses caused by extreme weather and climate-related events are insured. I repeat that, only 25%. And that will keep us busy, of course, because it is the topic about insurability and the pricing of climate-related risks, which are becoming increasingly critical, not just for insurers, but also for practitioners, for policymakers. And if no countermeasures are or will be taken, of course, this protection gap is becoming wider and wider and is expected to widen. So just to give you a glimpse of what will keep us busy, our voices on the panel will focus on that in a second as well. Our main question will be really tackling how can the insurance sector support prevention and adaptation, or do we need to talk about adaptation to climate risks? So there will be different voices from different sectors. And the German Federal Ministry of Finance already started this conversation at the COP26. And now it's the continuation of this conversation here at COP28. And with that, I welcome, of course, for the official keynote now, the State Secretary in the Federal Ministry of Finance, Heiko Thoms, is with us. The stage is all yours.
So I hope this is working. We seem to be having two events at a time. Well, I'd first like to welcome our panelists, ladies and gentlemen. It's really a pleasure today to welcome you all and receive you here at the event of the German Ministry of Finance today on Sustainable Finance Day, on our event on the role of the insurance sector in climate adaptation. I would also like to welcome all those who are joining us online. Germany has always been a vocal supporter of the fight against climate change. This fight requires all stakeholders, as we all know. It requires all stakeholders to work together closely to make the transition from a fossil fuel-dependent global economy to a more sustainable one a reality. The COP in Dubai sets the right theme, and we as the German government are happy to be here and hope to contribute to a successful COP. With today's event, we are resuming a topic that we have already discussed at the COP in Glasgow in 2021. There we had first touched upon the role of the insurance sector and what it can contribute to climate adaptation and mitigation. 2 years later, we think it is time to revisit this question, taking stock of what has been achieved, what challenges still remain, and which new ones have emerged. Of course, we also hope for some insights on how possible solutions to these challenges could look like. In 2021, sustainable finance was still a comparably small topic at the COP, albeit gaining more prominence. In 2023, it's safe to say that it has arrived in the mainstream, and I can personally say I've been in this job for 8 months now. Even in this short period of time, I see the topic picking up momentum. When we set up the panel back then, in 2021, we hope that it might help us with setting our priorities for a topic we considered important for tackling climate change, but was not sufficiently recognized back then. The panel highlighted that there is a considerable assurance gap, not only, but predominantly in countries that are most vulnerable to the effects of climate change. These countries are often also the ones that don't have the financial means to provide relief and cover losses on their own, loss and damage. During our G7 presidency at the COP27, the Global Shield was launched as a collaborative initiative of the G7 and the Vulnerable 20 to tackle this challenge. Of course, the Global Shield alone is not enough to mitigate all damages that climate change and extreme weather will cause, but it is a start. Germany has provided a considerable amount of seed money for the Shield. We will work on the further development and hope to build up a broader base of donors in the near future. What the panel also highlighted is the need for additional investments from private sources. As big institutional investors, insurers can contribute by investments in new technologies or projects that mitigate the damages caused by climate change, for example, flood protection. This can also reduce their insurance losses. Sustainable finance is all about mobilizing additional capital to build a sustainable future. At the same time, we have to make sure that risks are taken into account appropriately. For that, we require a common understanding of what sustainability means. We also need a robust data set in order to be able to make the right investment and business decisions. Money, obviously, is a limited resource. So the focus of our measures has so far been twofold: define what sustainability really is, what we all mean by it, and to improve the availability of data. One initiative that is trying to help with both these challenges is the International Sustainability Standards Board, which we are hosting in Frankfurt. A global level playing field and a comparable global baseline standard of information will be key for investors, but also insurers, to be able to assess risks and make informed decisions. This sets the scene for private sustainable investment. But Germany also wants to be a role model. We have implemented a number of projects to promote green financial markets. Maybe the most prominent one is the issuance of German green bonds. We are one of the largest issuers of sovereign green bonds worldwide and thus contribute to functioning green financial markets overall. And we have set up, that's the second point, our Sustainable Finance Advisory Committee. This independent multi-stakeholder platform brings together experts from the real economy, the financial sector, civil society, and academia. Its goal is to advise the German government on the further development of sustainable finance in Germany and on how to reach our goal to become one of the leading centers for sustainable finance worldwide. And this has been quite a success story so far. So at the moment, the committee is, for example, looking for ways in concrete terms how public and private partnerships can help raise capital for sustainable projects, especially in developing economies. So I'm happy that today we have again assembled an exquisite circle of knowledgeable speakers and panelists who, with their contributions, will certainly provide valuable insights on actual challenges and possible solutions. I hope for lively and insightful discussion and hope you'll enjoy the event. Ideally, we can take away inspiration for further steps like we did from our insurance panel we hosted last time in Glasgow. Thank you very much.
Thank you, Mr. State Secretary. And with that, I welcome now my panelists here on stage. Join me here on stage, and I'll do the quick round of introduction in a second. Günther Thallinger, Hubert Danzo, Pamela Schirmans, who will be joining us online, and Butch Bakani and Dr. Esther Wandel. Please join me. Here. Mr. Thallinger over there. Yes, over there. Wonderful. And thank you. So I'll do a quick round of introduction, and then, of course, we come to your different perspectives. Günther Thallinger is with us. You are a member of the board of the management of Allianz and the chairman of the sustainability board. Thank you for joining us. Next to you, Hubert Danzo. He chairs numerous boards and investment dialogues focusing on investment within the African continent. And you also work extensively with domestic and global institutional investors. You're the CEO and chairman of the Africa Investor Group. Thank you for having the time to join us today. Joining us virtually, and I hope you can hear me well, Pamela Schirmans. She is a principal expert on insurance policy at the European Insurance and Occupational Pensions Authority. You're based in Frankfurt, so greetings to you from Dubai. Great that you are joining us as well. Next to me on the right-hand side of the stage is Butch Bakani. You're leading the UN Principle for Sustainable Insurance Initiative, which is the largest collaboration between the UN and the insurance industry. Thank you for making the time here at COP28 here in the German Climate Pavilion. And last but not least, we have Dr. Esther Wandl also with us. You're the head of Division Investment Funds and Sustainable Finance in the German Federal Ministry of Finance. Wonderful. This is our panel, and we do have now a hot hour to debate, of course, what should be the focus of policymakers, of supervisors, of insurance companies going forward when we talk about climate adaptation. And of course, how does it all work together? How do we bring different perspectives together? What are the different goals? How do we combine them? How do we break the silos? And we hear that so often, right? How do we communicate better? How do we bring these different perspectives together? How can we talk about regulation and supervision, which are supporting the goal? And where are the limits, of course, of the companies, and what role has a policy instrument or have policy instruments? So with that, I'd like to join into our first round, and we do a little bit of a round de table for the first round, and then of course we open also the floor to you, ladies and gentlemen, here in the pavilion. We have time and we have the microphone for you, and we also have the Slido for you, ladies and gentlemen, in the live stream. So please join us virtually with your questions. The questions will be sent to the panel here, and then of course we will answer the questions. Mr. Tallinger, what are your thoughts when we are meeting here today to talk about the role of insurance sector when it comes to climate adaptation? What are the important hot takes that you'd like to share with us?
Well, as I'm the first speaker, I allow myself to start with this very, very basic introduction, but I will come to more concrete topics immediately. The very basic thing is, as you all know, in this insurance business is actually nothing else than providing a platform for many, many people to come together, paying a little bit of premium to then get rid of a certain risk, like insuring a house against fire. And that works because usually these houses are not kind of collectively catching fire. If you all of a sudden have a driver that increases physical risk collectively, the whole idea of diversifying and the whole idea of providing the platform starts to show cracks. That's, of course, the topic that we discuss. But we should bear this in mind. Why? Because whenever we have the idea that we can simply adapt to the increase of physical risk, we should know only up to a limit. Only up to a limit. And the whole reason why we need to adapt to the increase of physical risk is because we made certain decisions. Yes, we, humankind, quite some while ago perhaps, but we made certain decisions, and that's why we are in the situation that we need to deal with the increase of physical risks. That is also why I would like to emphasize very strongly, we yes need to talk about adaptation or adaptation, absolutely, but we always need to talk about mitigation, because what we don't want to have happen is that these physical risks increase forever, because then we certainly breach every limit that we have to cover these physical risks. So mitigation is part of the game discussing adaptation. Now back to our topic, which is adaptation. Insurers, yes, of course, can deal with adaptation quite a lot. What can they do? They can do so-called risk engineering. They can advise people on what risks are out there and how they handle these risks. They can clearly work on the risk management in the form of advising how certain forms of features, how certain form of resilience can be introduced in certain risks. So for instance, flood-prone doors, or certain form of fire protection, or a certain form of hail-proof roofs that can be introduced. That clearly helps mitigating the risk. And then thirdly, these insurers can obviously price this risk differently, because if certain risk doesn't really occur, they don't need to price, and then therefore people have clearly incentives to work in that direction. Topic 4 that they can come up with is different forms of product design. Parametric insurance is, for instance, such a thing. What is that? There is actually an insurance cover that is offered simply to pay out if a trigger event happens. Why is that of relevance? Because very often natural catastrophes hurts so many people at the same point in time that a long loss assessment process and then a claims management process is not really doing the trick for them. They need money actually right away when the trigger event happens. So paramedic insurance is a very, very nice form of complementing other insurance coverage. So that's the fourth thing. Insurers can come up with different forms of product design. And then there's the fifth thing that the people usually always talk about immediately, which is let's increase the risk-bearing capacity. What is that usually? Talking to the state, to the taxpayer to a certain degree and say, okay, can't you also come up with a certain form of risk capital that, let's say, complements the already existing risk-bearing capacity, so increasing the money that is available. On the last one, I dare to mention once again that I said at the beginning, we are in a situation because we made certain strategic decisions and now we have to adapt to these risks. The chance to increase the risk-bearing capacity is nice to have, but the only thing that does is it buys us time. Because we cannot, as I said before, we cannot increase forever the risk-bearing capacity. We only can do it up to a certain level. This buys us time so that we then can really work on mitigation and very fast. Because more physical risk, more risk-bearing capacity at a certain point in time will not exist, will simply not exist. That brings me to the topic of mitigation, just very quickly, because insurers obviously are also investors, and therefore they can work very, very well on mitigation. They can work in the direction of, let's say, adaptation finance, obviously they can. They can also work very, very clearly, let's say, with their so-called assets on reducing emissions, which helps, of course, to reduce the physical risks. So this part is something that insurers cannot say they cannot cover. They can cover adaptation, but they can very, very much also cover mitigation. And to end, at least insurers should very, very clearly focus on the topic that we are discussing here, in particular on both sides, adaptation and mitigation. Insurers in particular, as investors, should not invest that much into assets that continue to pollute and to continue to increase the emission levels. Why is that? Because if on the adaptation side they need to actually retract, meaning they can no longer be part of the insurance markets because the physical risks have increased so much, they have destroyed their own business. This is how the whole circle closes. That are my introductory remarks.
Yes, absolutely. Thank you. Thank you, Mr. Tallinger. Hubert Danzo, when we talk about our topic now, what are your thoughts that you'd like to share with us before we talk, or before we have our conversation later? But this is your time, of course, for sharing your thoughts.
Am I on? No?
I think you switched on. Yeah, I think so. Did you?
Well, first of all, thank you for the invitation, and thank you, Günther, for saying everything that I would have said. So I completely.
I was the first one.
Yes,
sorry.
indeed. I completely concur with you. I'll give a slightly different view, really much, from an African perspective, looking at the sort of the infrastructure investment dynamic, and I think we. On the continent, we have to transform before we transition, and we have, a lot of adaptation-related issues, but we have, a very large infrastructure investment deficit. And if you look at the nationally determined contributions that we have, we know that that's, we have a slightly different problem and a slightly different priority, which is we're talking about $3 trillion worth of nationally determined contribution commitments or aspirations that will need financing. And I'll actually continue to move into the word investment, because this underlying regulatory dynamic for us on the African continent is much more about a private capital mobilization issue in the very first instance. We've sort of been seen to be much more of a development project than an investable market, and therefore most of the things that happen, whether it's the insurance market, whether it's the infrastructure, equity allocations, whether it's the infrastructure debt markets, it's all suboptimal. So I think one of the things that we would start talking about in the very first instance is how do we change the mindset? I think the Secretary of State talked about COP26? Yes. Well, it took COP26 to get the private sector into this discussion in a meaningful way. So I think we really need to get the investment community into the conversation in a meaningful way. And because we haven't been able to get the investment community into the conversation in a meaningful way, the underlying regulatory environment is not conducive for capital to flow at scale. So all of these different insurable related opportunities need to be on the back of a market. And if you look in the African continent, it's completely suboptimal. If you take $3 trillion worth of NDC projects, if you're looking to de-risk a lot of these particular underlying opportunities, it's usually about a third, about 27% of that is usually some form of blended or de-risking instrument. So that basically means that just for African NDC projects, you need about 550 billion to 750 billion potential cover, or instruments that can actually de-risk that proposition. So if you look at, what is the capacity in the market currently, you're looking at African Trade Insurance Agency. That's a $400 million balance sheet. Everything it touches gets reinsured, and it's got a backstop from the World Bank. Not a real market in relation to, how things need to go in the orders of magnitude. But then people say, well, actually, let's just rather look at MIGA, Multilateral Investment Guarantee Agency, $60 billion balance sheet. That's not anywhere close to 550 billion or 750 billion, and 66% of that's from the private sector. I mean, just in terms of, how they actually get that cover. So I think we need to change the way that we think about this entire agenda. We seem to get pulled into conversations that are already sort of set in the frame, and then we're trying to do the best within a suboptimal arrangement. I think we absolutely need to be able to say, how can we get to the target? If we know the house is going to burn down in 2 years, let's not make a 5-year plan. And I think the strategy that we've really got to be able to do is address this issue of scale. And I think we have nice ideas, and I think we have nice instruments, but I think they're suboptimal, and I think that's why we're always going to be running around on the risk transfer or the risk sharing issue. And I think that's a key part of the problem. When you come to emerging markets and you come to the developing countries, data is key. If you don't know or understand that risk, of course you can't manage it, and that's where you start getting into some of these slightly emotive issues like does the public sector share the data that they have to crowd in private capital to do things like underwrite and ensure adaptation and mitigation, or do MDBs and DFIs perhaps keep that to their chest and potentially cost emerging markets and developing countries $15.6 billion each year of excess interest on their loans? So I think we need to take a very different approach to how we seek to enfranchise emerging markets and developing countries, both from the, as Gunther was saying, both from the adaptation, but also from the mitigation side. I think there is a new business model that needs to evolve. And I actually believe that there's enough liquidity and opportunity if only we can see it through a positive lens. So let me stop there. And thank you again, Gunther, for your opening remarks.
Thank you, Hubert, for sharing your thoughts. Pamela, I'd like to come in with you here now. Maybe you can share your thoughts that are important to you when we talk about our topic today, when we talk about the role of the insurance sector in climate adaptation. What's important for you to mention as a start?
Thank you, Kathy. Thank you, Kathy, and the other panelists. I think you've given a perfect introduction already, and I will try to build on that, because we've heard from Gunther, indeed, there are limits to risk-bearing capacity, and we've heard also then later on that there is a need for adaptation finance. What I would like to focus on is indeed we're vacillating between mitigation and adaptation, and the smaller the progress that we're doing on mitigation, the more we need to do about adaptation. And it's not about which comes first, but I think we have to take care of them both at the same time, because we are already witnessing now that natural disasters are causing more and more damage to livelihoods, to property, and this is turning into a chronic problem. So what we see is indeed, we fully agree, and then we're very supportive that the insurance industry has a very important role in covering the losses for these damages. But indeed, this has never been more important, but it also is becoming more and more difficult. And we see that insurance is becoming harder to get, it's becoming more expensive. And that's what we see as the insurance protection gaps. You've referred to it in your introduction. With our climate insurance protection gap dashboard, we see that there is a gap that only 25%, 20 to 25% of all the losses in the European Economic Area are actually covered. And then we're talking about losses that are arising from earthquakes, which are not necessarily related to climate risk, but we're also seeing wildfire, flood, and windstorms and other natural catastrophes in Europe. So that is a very important aspect that we have to tackle, these insurance protection gaps. We see that there is a role for the insurers, and we've also seen that there is an increasing opportunity, but also a responsibility of financial supervisors to deal with that. And we've recently issued a paper with the IIS, we've worked with the IIS on this paper. What kind of actions can supervisors actually take to support the industry, but not just the industry, but to support what we call shared resilience solutions? And there are three areas in which definitely insurance supervisory authorities have a role to play. And one is because they are there to preserve financial stability. And how can you preserve financial stability if your economy is subject to very large economic consequences of natural catastrophe events, which have to be funded either by the governments, which already have large public deficits? So it is to contribute to financial stability. But of course, the role of financial supervisors is also to protect consumers. And we see that consumers have to be treated, protected and fairly treated on their coverage for natural catastrophes, where they see that sometimes they are not sure about which type of natural catastrophe consequences they're actually covered for. And also, as Günther importantly also noticed, that timely claims resolution is important. So we have to make sure that the appropriate regulatory and supervisory solutions are in place to ensure that. And of course, also supervisors in some markets more than others have a very important role also to support financial inclusion and market development, especially where there are certain segments of the market which do not have access to insurance. So what are then certain types of activities? I will raise two of them because I think they're important for the conversation later on. There is one key important activity that supervisors can engage in, and not in isolation, but engaging with the insurance industry, but also with the consumers and also with the public sector, and that is to incentivize risk prevention. The risk prevention, but also with the aim, and that's the purpose actually of risk prevention, is to limit the losses in a risk-based manner. And that can be done by supporting regulatory or supervisory tools that actually enable adaptation measures to climate change, for example, flood-proofing houses or climate-proofing property generally, to integrate that in the underwriting. And that is mainly by addressing the risk premia or by addressing the reserve risk of these underwriting activities. So I think there's a really transformational adaptation in the underwriting practices that can help to a certain extent, as Günther also said. And that is something, this policy action can be supported also by the data and knowledge sharing that we have, because some call it hot houses of information. We are collecting information, but we're also very supportive of making this information much more widely available to support, and then we come to a key term, the alignment across public and private actors on prevention measures. And that is because we do not want to operate in isolation. And to close on this, one of the actions, and everybody's referring to COP26, some of you may remember that we had actually made a commitment to deliver a tool to measure these protection gaps. Well, we've delivered that tool in December last year, so we have a dashboard now by which we can measure how protection gaps for natural catastrophes are evolving under these climate risk scenarios, but also by now we're actually using them to engage with the industry and the public sector to really come to informed policy measures, addressing the vulnerability, the exposure, or other insurance scheme related solutions that could be taken. So that would be my introduction on how I think not only the insurance sector can contribute to climate adaptation, but also the financial supervisors. Thank you.
Thank you, Pamela. Of course, thank you again for joining and sharing your thoughts with us. And I noted down a few keywords. We're going to dive into these keywords in a second. Butch is also with us. Maybe, as this is still the round table, what are your key thoughts that you would like to share with us? Why did you decide to come on that panel, and why it's always crucial for you to share?
Sure, I have a million thoughts. So first thought is that I think we should try to avoid making adaptation and mitigation to be competing concepts. And for me, there's a way to unify it. I think adaptation is a form of risk reduction, coping with the impacts of climate change. Mitigation, for me, is also a form of risk reduction because you're reducing climate risk at source, which is greenhouse gas emissions. So I think if we unify that both adaptation and mitigation is really about managing risk, we can go further, rather than say this is adaptation, this is mitigation. So I think that's number one. Number two, I think we need to understand better the gravity of the situation, because I think it's more acute in the global south. So the situation is more acute. So the one statistic that I know that has been put out there is that the vulnerable 20 group of countries, which is made up of 68 of the most climate vulnerable countries, in the last 2 decades, about 20% of their total wealth has been wiped out due to climate change. That is a staggering figure if we have to take that into account. Yes, the loss and damage on day one was important. And we should, I think, consider the pledges to be seed funding, because the scale of the problem is really big. We're expecting losses and damages by 2030 to be in the tune of 400 billion, and by 2050 to be 1 to 2 trillion. So for me, the way to help organize our thinking around it is going back to the insurance concept that Gunther alluded to earlier. And for me, the best way to understand and address adaptation is to understand the risk management continuum that has been applied in insurance for many years, in fact, centuries right now, since the modern day insurance was invented, which is first, how do we better understand risk? This is why risk modeling in the insurance industry is very integral, from catastrophe risk modeling to using scenario analysis right now for climate change risk that goes 10, 20 years down the road. That expertise shouldn't reside within the insurance industry only. That should reside in the public sector, in businesses, in terms of understanding risk. When you're able to understand and quantify risk, then you can have strategies to prevent and reduce risk. This is why insurers have been advocates of seat belts, flood protection measures, fire hazard risk reduction measures. Then you start going into what Pam said. How do you prevent and reduce risk? And obviously, we live in a world of risk. There's no world without risk. So there will always be residual risk. And that residual risk is that risk that could be shared with the public sector or the private insurance market in terms of risk transfer instruments such as insurance. Then you go into the risk-sharing space. What is the solution set there? The solution set there we should also organize ourselves. At what level of risk are we trying to address? Is it at the macro level, where you're looking at countries or regions like the Caribbean? Is it at the meso level, where you're looking at local governments and businesses? Or is it at the micro level of individuals and households? And in that front, there has been a lot of experimentation over the years by the insurance industry and governments as well. This is why you have the Caribbean Catastrophe Risk Insurance Facility. This is why you have the African Risk Capacity, you have the Southeast Asian Disaster Risk Insurance Facility. These are macro-level schemes to address sovereign-type climate risk. Then there's a lot of experimentation that Gunther alluded to in terms of smallholder farmers in Africa or in Asia who need parametric insurance for crop or livestock. And that's important because there's a lot of experimentation there. What we found out at UNEP and the Principles for Stable Insurance is that there's the meso level that's largely unserved. And this represents largely micro, small, and medium-sized enterprises, which if you look at in the Global South, it's largely unserved by insurance protection. This is why I think we need to better understand what levels of risk that we're doing. And perhaps final thought for me in terms of framing the understanding, I just want the discussion to progress, since this is from COP26 to COP28. I think that next time we have a discussion, we should ideally start from a higher level of starting point based on our discussion here. And
What do
for
you mean by that?
And for me, what I mean by that is that I've attended a lot of events on adaptation and insurance over the years, and I'll give you my summary on what's inhibiting insurance solutions to be driven at scale. One is things, let me just summarize it to you in 5 points. Poor disaster risk reduction measures, whether it's poor land use planning and management, a poor implementation of building codes and standards, poor risk reduction measures, and poor disaster preparedness. That's very poor, the underlying risk will increase, insurance ultimately will become more expensive. Low insurance penetration and density because of lack of access to affordable and accessible insurance. Low insurance literacy. Insurance products not designed for the most vulnerable, and lack of enabling policy and regulatory frameworks. I'll stop there in terms of summarizing, but I don't want to repeat many things in conferences that we've heard a million times.
Thank you for your keynote. I know you have a comment. Can we just keep that comment for 2 minutes? So I'll have one more keynote, and then we go into that, because I think there's a little bit of heat here. And then I come back to you. Is that okay? What are your thoughts? Because I didn't want to let you out. Not summarizing everything what we just heard, of course, but again, bringing your perspective in, and then we start into our conversations, also with your questions, so get ready.
Yeah. Hello?
No, I think you switched on.
Yeah? Can you hear me? Okay. So, yes, thank you. So it's a bit difficult, obviously, to say something on top of all these distinguished speakers. And I have to say I concur also with some of the comments already made. Obviously, I mean, I come in from that debate again to a certain angle which has also been raised, but which I would like to underline a couple of the facts which have already mentioned. The first is, I mean, the question is what we expect from insurance companies. So, and it seems to me that what we have heard seems that they're assuming the roles, but I think there is something I would like to highlight a bit more. Obviously, I come also very much from the capital market side. So first, for me, insurers are institutional investors, and that's a very important role they have in driving the transformation, because their decisions, and I think Günther made the point already, they have a major impact on the financing of sustainable investments. And that is something we care a lot about. That is why we want to work on Capital Markets Union. We want to make this role even stronger and better in the future for institutional investors. The second one is, and that is something I think also Günther, but also I think Butch alluded to, it's the role as risk managers. I think this is absolutely vital. And we think this is extremely important that they take on that role. And they have different tools to do so. I think the toolbox is relatively broad. There is the idea of active stewardship, so really working with the firms and reducing their greenhouse gas emissions. There's also their role in basically managing the risks by policy on premiums, and by their risk management themselves. I think their own risk management is also a very important tool. And I would fully concur that we should not go into this trap by saying adaptation or mitigation. I think we actually need both, and insurance companies can be also institutional investors doing both. I think that's also very important for me to underline. And I think then there was a point, I think, which I thought was very interesting and which was also on my list, actually, which I wanted to highlight, is this role of insurers in terms of collect and share risk-related information, because I think that's very important. They can raise the awareness also of climate-related risk exposures in this respect. And I think the quality of data, but we might talk about that in a minute, I think is absolutely crucial here, and that is also why we very much support the work of the ISSB here in Frankfurt, because they are really will provide, they have already delivered the first set of standards, will really provide a very, very important basis in helping the insurers in assessing and looking at their risks and also at the chances. So I would leave it like this. We might get into some of the
come back to a few points. I'd like to come back to you, Hubert, because you were raising and you come in after the comment of which. So where was the point where would you agree or disagree?
No, I agree very much with most colleagues here and all colleagues here, but I liked what Butch had to say in particular about, look, we know the problems. Scale is the biggest issue. Why don't we start at scale and then, of course, bring in institutional investors to optimize our ability to be able to address the situation? And I think that there's not enough conversation around that. It's almost as if we want to dissect and sort of segment adaptation versus mitigation and have this conversation. Well, I think it's a different business model. It's interoperable in some respects, in many respects. We need to be able to bring the institutional investors in at scale in the most responsible and optimal way. I just wanted to then ask Butch, I mean, he identified the issues, those 5 or so issues, but what are the solutions if you were to look specifically at crowding in a responsible way, of course, long-term institutional capital to address these issues? And I was just going to give it the bent of as it relates to emerging markets and developing economies, because we've just got a loss and damage fund, and everyone knows that it's nice to have it, we need to have it,
but we need more also.
But the scale as well, we get so much into the technical detail, but then when it comes to the scale, I think we all go missing. So I just wonder how we can really, that's why I liked what he said in terms of about how we can really just focus on what really matters, not take a year to come up with something tiny, although the tiny has an architecture that we can leverage. So I'd like us to be able to get to that. How do we leverage this? How do we deal with the scale and in the more challenged parts of the world? That was really my
That is like a direct question to you.
Sure, that's an easy question. So I think one answer would be what I mentioned. Just to talk about the institutional investment, I totally agree with you and Gunther. I think globally, we know that the insurance industry has around 35 trillion, at least, in assets under management. The way that capital is deployed would have a telling impact on both adaptation and mitigation. So let's just talk about, let's say, resilient infrastructure, right? So one key to that is, one of the things for me is key is better disaster risk reduction on the ground. Insurers can only advocate for this. Governments need to take action. They're not the ones making decisions on land use planning and management. So if you're going to have trying to look into port or a bridge where you haven't taken into account sea level rise or other factors, that is not a good way to attract and crowd in institutional money if you haven't factored in those climate-related issues into land use planning and decision making. And what investor will go into that if you haven't really factored into that? On the insurance side, I'll give you one example that is very concrete, because UNAP is hosting the V20 Sustainable Insurance Facility, whose project office is funded by the German government through BMZ. So I'm happy to promote that, and my colleague who's leading that is actually here. And the scale problem here is one of the things we were wanting to address, which is micro, small, and medium-sized enterprises. If you look at many countries around the world, not only in the global south, but even countries like Italy, for example, MSMEs are the backbone of economies. If they are constantly shocked by climate change impacts, then there is a telling impact on development, right? Socially, economically, environmentally, etc. So our idea is, we know enough of the problem. We don't need more analytics and diagnostics on what's the problem in insurance protection for these. So our basic idea is that how can we have a template approach? What works in particular markets? There's been so much experimentation on parametric insurance or indemnity insurance across different markets around the world. What works? What doesn't work? And for those things that work, how can we actually apply that consistently across markets, because we know they already work, and achieve the scale that we need. And once we achieve scale, we can expand cover for other sectors and other types of perils, for example. These are some of the, and so we're working on a concept that one of the key problems on scale in insurance is that the whole transaction is very expensive. Particularly if you're looking at small and medium-sized enterprises, the distribution becomes expensive. So we're trying to work with banks, microfinance institutions, large manufacturing firms who want their supply chains to be resilient to climate shocks. So we want to provide them with climate insurance. And so we're creating a pipeline of projects, and we're now seeking whether donor money, private insurance capacity, or philanthropic money to insure those MSMEs in the supply chain. So, and we think we can bring that to scale. We have to show that we can scale that, because I agree, it's a scale problem. The other problem is a speed problem. A stitch in time saves 9. So as the saying goes. So if the money goes too late, then the economic and social consequences of climate shock would be much more severe. Mm-hmm. And this is why what Gunther said, parametric insurance over the last decade or so has become very popular, because it's trigger-based. If you exceed a certain wind speed or a certain level of rainfall, there's an immediate payout. And that's important. So I would argue, yes, scale is important, but speed to the most vulnerable is equally important.
Thank you, thank you. Gunther, I'd like to come back to you, and then Issa and Pamela. I see you both raising the hands, but I'd just like to just go straight to Gunther. How can you be an architect of scaling up and speeding?
Yeah.
As an insurer.
Just because we may actually miss a few key points, let me mention these key points first, and then I come immediately to the architect thing. Lots of the topics that we are discussing here would actually have an immediate solution step if we introduce a price of carbon globally. This is, we are in the game immediately. If we would start to think about subsidies, fossil subsidies differently, in the form of we subsidize those who are really in need and not the products, we have a second part of an immediate solution contribution. And the third thing is, as Hubert mentioned, if we were willing to use data that is already available, credit risk data, for instance, for certain emerging markets, if we would use those, and we have data pools where certain institutions are sitting on the pool but not providing, let's say, the insight into this pool, we have the third big step into the topics that we just discussed. But now, as we don't want to introduce a price of carbon, as we want to subsidize fossil products as we do, and as we don't want to share the data, we discuss, of course, other topics. Let's discuss the other topics. The other topics are indeed, how do we go, let's say, for insurers to really come in? And I do very much agree. I do agree. The topic is, of course, scaling certain solutions. Yes, of course, we need to scale certain solutions. But we mentioned now already the solutions, all of them. Or we did talk about we need to provide the risk insight so that people can really mitigate their own risk taking, manage their, let's say, own risks themselves. We need to provide the information so that there are certain forms of, let's say, physical risks taken out from certain assets. We have mentioned already these things. We talked about the product design. We need to pay out immediately. The trigger should be actually the incident and not the loss discussion. So I fear there is actually not so much to add to this other than that we indeed use this information and work on a scaled basis. There is not so much of miracles to this. And sorry for speaking a little bit too long. I do have the feeling that as we know all this, it's really interesting to notice that we go on and develop kind of concept papers on interesting things. For instance, we do know that we need, and that's also again very trivial, I'm sorry for this, it's very trivial, we need to reduce absolute emissions. Now we are getting together here by 100,000, and we spend time to talk about avoidance of emission and certifying removal. That's what we do. When we know we need to reduce absolute emissions, and we have all the means. We have all the means of that. Sorry, it's not adaptation, I know, but I just need to mention the point that we are making, we know the things, needs to really somehow be appreciated And as we know it, then we may, and there you are right, the next level may be that at the next COP we really come together because we say, okay, we have really started to work on that basis. We have really used this knowledge and we implement on that basis. We are not going to another COP where we then have the discussion. Now we have again thought a little bit about this thing of emission reduction, and here is a good idea. Avoided emissions also need to be dealt with. No?
Again, are you an architect for scaling up then, as an insurer? How will you be an architect of scaling it up?
Yeah, the architect, oh, now it's gone. Will you still hear me? Yes. Ah, yeah, cool. Let's say the architect of scaling up is as I say, you don't develop new concepts, you use what we discussed here and provide this. Yeah? But that is what let's say a larger part of let's say the industry is attempting, but it really requires that a multitude of players come together. The data point that Hubert mentions is not a data, let's say a data pool that the private sector has access to. That's exactly the point. We want to have, let's say, the access, then we can talk about credit risk of emerging markets in a different form. And I'd like actually that you explain perhaps once again what we are talking about, so that there is the scaling no longer a game where only the insurance industry, where only the investors, where only, let's say, PSI or PRI can work. No, we need to actually work together on these topics. We need to appreciate that we know it, and then we need to follow through on it jointly. That's the scaling.
Pamela, you want to come in, and this is now your floor. So when we talk about scaling up and speeding up, and of course meeting here at COP28, what are your thoughts? You know, we have this conversation coming from COP26 now, COP28. So what is on the priority on your list and on your desk?
No, and I agree that we've been talking about similar concepts for quite a while. It's true. What I get from this conversation and where we are at is that we have to continue advocating for a global system approach, yeah? And there are three areas of importance, and I may sometimes disagree with what some of the panel members have been saying, but let's look at the first area. We talk about pooling of expertise, pooling of data. The global shield has been set up. And Günther, it is true that the insurance industry does not have access to all data, but also the insurance industry is a very large powerhouse of data, which it could share. And in particular, if we're thinking of insured losses arising from natural catastrophes. So we're very much working on that, also as EIOPA, in order to put together the overview in a structured manner of what are the insured losses arising from natural catastrophes. And then we're really talking about adaptation. I'm not talking maybe so much of investments, but that is something, the pooling of expertise, the pooling of data in the global shield, in freely open source accessible databases for policymakers, private sector, and public entities or stakeholders to actually have a look at what data can be used to improve prevention measures. And then we come to how do you improve prevention measures? And what I see, there are nationally defined contributions, there are national initiatives, but they still do not add up to a global solution. And I think what we still have to make, and how do we do that? I think we really have to have stronger commitments on aligning prevention and adaptation measures. And that is something really difficult. And I think there's the crux of the matter, because then you also know if we need to invest in these prevention measures, these investments can also be directed much more globally. And then I'm talking of prevention, but of course, as one of the members of the panel said, prevention measures also include mitigation, because then you reduce the risk eventually of having the damages. So I think we really have to have common agreement or common views on what we're going to invest in. And what has not been, I think, addressed in the panel yet is really the trust in the transition. And I think we really have to address greenwashing, because greenwashing really contributes to climate despair, as one would say. If you can't trust the net zero commitments of the industry or the net zero commitments of politicians, what are you then looking at? And this is really something we have to you can say walk the talk. I think we're all fed up with that, but we really have to go from policy to practice. I fully agree with the panelists. We have all the concepts on the table. The regulation is slowly getting into place. There's a lot of regulation. Let's not add too much to that, but let's start implementing and let's start drilling down what the key measures should be.
But again, Pamela, you said stronger commitments. And for me, again, with these buzzwords, I immediately dive in. So what do you mean by that? Give us a concrete example.
Well, it is very difficult to actually, as an insurance industry, I think the insurance industry has seen very big difficulties these days in committing globally to net zero reductions in their investments. And I think that is something that has hindered maybe also some action, but that is a commitment that has to be taken globally. So these commitments to really reduce investments, as Günther said, to really reduce investments in assets or in sectors that contribute to greenhouse gas emissions, these have to be followed up and these have to be scaled up. But I also understand we all are aware that these are difficulties. Are there the relevant investments? Can they be made? Are they available? Can they be scaled up? But of course, there are also reasons why some of these measures cannot be taken these days. And that is, I think, we have to make these commitments follow suit.
That's a direct comment, and then is Günther, please, and then is a comment.
I actually need to directly comment on this one because we do have the Net Zero Asset Owner Alliance. We are 86 members. We have committed to, let's say, Paris 2015, C1, no low overshoot scenarios. We also have published our third progress report, and in the third progress report, we have published that absolute emissions go down in the aggregate of our portfolios. So we are on the game, and we do scale. We do scale. Yes. What we, however, need to have is that more of the financial institutions join in. We are 86 now. We need to have more of them. And what I was talking before was when we have, and I speak, of course, because I was a member of the UN high-level expert group on net zero. When we have already a paper out there with 10 recommendations, and then there's a recommendation 4 that says, okay, how a transition plan looks like. We don't need another concept paper how to do a transition plan. We just take what recommendation 4 says, we develop the transition plan and report back on how we do the implementation. But we should, and there I agree very, very much, we should, however, make sure that the integrity is there. We should not allow that others tell all of a sudden, I have a transition plan, and that thing has, for instance, not even a target for 2030. We should call out on those who say, okay, there's a transition plan, and so we clearly ask, okay, is it really covering what the high-level expert group of the UN has defined? And that's very important for the scaling. If we know what we need to do, we need to actually do it. And not say we do it, but then if you look into the details, you learn it's not done. We just say that we do it. Yeah? And scaling efforts are clearly there. They are there. More need to join.
Esther, why are we still in this phase of communication, what Günther just mentioned, we need more action. We don't need more concept papers. We don't need more ink on the paper. We need more action and support. Why are not more people and more insurers and more actors and stakeholders joining?
Naja, this you might better ask here the industry players, but I wanted to highlight a couple of 2 other points which I think were a little bit drowned in the debate. A small point, I think, much made, and then I fully agree. I mean, we need more people joining, but it's their decision. I mean, if you commit to these goals, which have been set out, for instance, by the UN, then we have the Net Zero Alliance, and we would wish that there are more people joining this. This is very clear.
But you as a ministry, you can also communicate, and you can also, not force people
to
join.
No, that's not what we would do. We would always like to do that on their own back, because it's really their market decision to do so. But I wanted to come back to one small point Butch made, because he said something about investor education or consumer education and insurance literacy. I think that's a very important point, and that's also a global issue. I fully agree, and it's good that this starts taking up again a little bit more, because the OECD has started a process around that, which I think is quite important, because it's sometimes too much neglected in the debate. So I think that's an important point Butch made. And as I said, I mean, we believe that really market players have to do this by their own thing, and I think the point you made on transition point is really transition plans is very, very important, I think, because we think that's exactly a strong market tool by if a firm, be a financial institution or a corporate real economy company, sets out its targets and market players don't think it's credible, it's helpful, it's not leading to the path of transition, then the market has a good tool to decide. So this is why we're very keen on working on that tool, because we think that is probably coming back. We have a lot of regulation, particularly in Europe, many of you might know, but we think that sometimes that tool would be a much better stimulus in order to take decisions by investors if they see these goals. And then they can make their own judgment call whether this is credible or not. And I think this is terribly important.
You want to comment on that? And then I have a quick look around if there's any hand signs. Otherwise, we go on with the online questions in a second. So Hubert, please share your thoughts and also bring in your perspective again. As you mentioned earlier, we also need to leverage private capital more and more and more, which is a different question now, but maybe you can combine your two thoughts on that.
Yeah, no, I think we're in the right place in terms of this conversation about the scale, the speed, and the action. And I particularly like Pamela's point about, there is this global emerging markets database which pulls together all of the data on the performance of the loans from the multilateral development banks for decades now. And it is invaluable for us as the investment community to be able to assess the risk and really understand, how to deal with the credit risk related issues for emerging markets and developing countries. And we've been asking for this data to be democratized for decades. And as I mentioned earlier, from a development institutional standpoint, the mere fact of not sharing that data as sort of development partners is actually costing emerging market and developing country governments over $15 billion each year in excess interest on their loans. So really that data should have been made available immediately, and it's exactly what we've been calling for as the investment community, so that we can actually increase our allocations to emerging markets and developing countries, touching on both adaptation as well as mitigation. So I think that's really important. However, we're all interdependent and interconnected in this sort of area that we're working in right now. We're all here in Dubai for a reason where we could be anywhere else in the world, because we genuinely care and we think that we can be part of the architecture for the future. And I think in that respect, what Pamela was saying, even on the GEMS data, we have to wait for that critical data to come from the multilateral development banks. We understand from Secretary Yellen and a number of other finance ministers and some heads of state that it's imminently going to be made available. But we as the institutional investment community have really come together on something called GEMS 3.0. Because the GEMS initiative, where we're now being told that imminently it's going to be made available, they've described that as GEMS 2.0. And this GEMS 2.0 is really just an agreement in principle of the owners of that data, being the multilateral development banks, to disclose the data to us as investors and to credit rating agencies and others to better inform investment decision-making process. But we believe, because of the need for scale and because of the need for speed, we need more than just disclosure. We actually need to create something which is much more of an asset allocation at scale tool. So we've actually started to build that in the form of GEMS 3.0, working with the industry to be able to get data from the industry that could be relevant in anticipation of waiting for the data from the MDB. So we're working with credit rating agencies, other institutional investors, and you caught my attention and imagination, Pamela, when you said that you're already aggregating and bringing together a lot of this important data. So let's see how we can work together and create those unique data sets that can ultimately become asset allocation tools or data-driven instruments that can actually help us get to the scale and be able to deploy these instruments at speed. We think that in Africa and other emerging markets and developing countries, and in Europe and the US, the legal and the regulatory arrangements around how to invest in climate in these areas. That's why we have an Inflation Reduction Act. Everyone's trying to speed up things. Everyone's trying to be able to make things so that you can do it at scale. Similarly, Net Zero Industry Act in Europe. We're doing something very similar on the African continent. And we think that this is how we begin to integrate and have a different taxonomy. Everyone talks about the taxonomies around adaptation and all these things, but they rarely involve the institutional investment community's views in the final product. You know, we've had a number of conversations here with sort of different public sector groups, including multilateral development banks. They talk about taxonomies, and they're almost ready for distribution and public show. And you ask them which investors that these principles are supposed to crowd us in have you consulted? And it's the end product we are very rarely consulted. Then it's a prize moment when we're not crowded in at scale. So I think we need to play our role. I think we are playing our role. I think we can all do better. We all need to do more. But I think this joining up, and I applaud what your ministry is doing, because the fact that we are here, Gunter and I, shows your commitment to this area, and we'd like to be able to see how we can focus wholeheartedly on this scale and speed issue, because I actually think that the outcome could be very, very positive for all stakeholders and constituencies. Thank you.
Thank you, Hubert. I hear a lot of to-dos and your priorities. So I have a simple question. If you could call anyone in the world right now to fix maybe your top priority, who would you call? Because there's so many to-dos from so many perspectives, but just to knock it down again, who would you call? If you could call anyone in the world, you've got the phone number, just imagine that. Who would you call then? Who do you need to talk to fix your priorities?
Well, that's a very good question. I was thinking about that, the other question that you had earlier about, what would you ultimately like to see in the world? And I think what I'd ultimately like to see in the world is the trust barriers broken down, because it's all of this delay, all of this lack of scale, all of this suboptimality and lack of speed, it's all founded in a lack of trust. If we could deal with the trust issues between the public and the private sector and the multilateral development banks institutions, we would not be waiting for 10 years for a GEMS database. Public sector wouldn't be complaining that private sector is only profit motivated. Private sector wouldn't be complaining maybe that the multilateral development banks have different priorities. It's the trust. That to me, if we can address this trust issue and align, because we have a common interest for humanity, that would be my answer.
Yeah, thank you. Would you agree? Do we have a trust issue? And maybe from your perspective, how can we deal with that and how can we fix that?
I think there's a trust issue across the board, whether it's public or private or other sectors. I think the only one way to fix it, I think, is to show accountability for your actions. I think whether you're in the private sector right now or the public sector, you can't really do away without having, for example, a climate strategy. And one of the accountability measures in the private sector or in the insurance industry are these net zero commitments. So I think it's good to see that companies like Allianz have a very strong view that net zero should be firmly in the agenda of everyone. Whether you're in the real economy or an insurer or a government, they should be firmly on the agenda, and it should be credible and ambitious, because that's what science is demanding. And I think if we all do our part in doing that, there will be greater trust and also greater justice. Yeah.
I have a question from the online panel, from the online audience to you, because you mentioned earlier the insurance literacy, and you were also underlining that. So the question from the audience comes as follows: so what is needed to improve insurance literacy? So I'd like to ask you that, because you mentioned it and you brought it up. Insurance literacy, what is needed to improve?
Good. So we're in the solution set now. I have 4 suggestions, and everyone has homework to do, including BMF. So one, just part of the solution to that is that I think the insurance industry at large should champion the common language of risk. If we're able to almost codify the risk language in terms of, does it go into the understanding risk bucket, or quantification and modeling bucket? Does it go into the prevention bucket, or does it go to the risk-sharing bucket? Then we'll have a clearer picture of how to better manage risk. So using the language of risk that insurers have used over many decades would help, I think, society at large about that, because it's all about risk management in general. Second, for BMF and insurance and other ministries of finance and insurance regulators and supervisors around the world, most countries, the insurance regulator and supervisor fall under the Ministry of Finance, right? And that's why I'm saying it's also BMF. So last month, the global body of insurance regulators called the International Association of Insurance Supervisors came up with a paper on the role of insurance regulators and supervisors in addressing natural catastrophe protection gaps. And they made 5 big things. Assessing insurance protection gaps, 1. 2, improving literacy, financial literacy and risk awareness, 2. 3, incentivizing risk prevention and reduction of insured losses. 4, creating an enabling regulatory and supervisory environment to support availability of insurance and uptake of coverage. 5, advising government and industry on financial inclusion and societal resilience, including on the design and implementation of public-private partnerships on insurance schemes. If all insurance regulators in the world apply that with the mandate, strong mandate from the Ministries of Finance, we'll go a very long way in terms of addressing many of the challenges of the protection gap. And then the other 2 would be for the COP, since we're at COP28. I think personally the Loss and Damage Fund should seek to complement, support, and amplify all the existing schemes there that have been proven to support closing the protection gap, whether it's the Global Shield, the V20 Sustainable Insurance Facility, the African Risk Capacity. There should be a very strong complementarity there that would support these schemes and not to reinvent the wheel. And finally, on the investment side, because Gunther and...
You're looking to Gunther and Hubert, yeah.
And for me, this is, I think, completes the picture for the insurance industry. I think globally, the potential of the insurance industry as institutional investors for climate resilient infrastructure hasn't really been fully harnessed yet. And I think we should harness that to the best of our ability, because for the insurers, that will also be another role. The investments on infrastructure that they can invest in as long-term institutional investors, they can also de-risk that through insurance solutions. So I think we should also harness that capability of the insurance industry. And as Gunther already mentioned, it's not only for resilient infrastructure, it's also for the net zero transition that we could use that as well. And I think if we do that by COP29 next year, if we do all of that, we would have gone a long way in adaptation.
Thank you. You brought up a topic that I'd like to ask Gunther, because there's also a question coming from the online audience, which is the connecting dot a bit. How can insurance companies scale up private capital for sustainable economic activities as institutional investors?
Yes, in institutional investors, the insurers can invest what they have on their balance sheet, the aggregate of their balance sheet. So they can do more insurance business, then they have more left-hand side, and then they can invest more quite clearly. But they also need simply, let's say, the capital that is provided by shareholders.
Yeah.
Or if they are mutuals, by their own policyholders, or if they are public, let's say, state-owned, then by the taxpayer. But it depends on the risk capital that is available, and then we go into, let's say, various of the aspects that we discussed. We are more efficient, as Butch said, more efficient in terms of the risk management, the risk understanding, and the like. But what we need to be aware of here is, we most certainly talk about an aspect of long-term management. And capital markets at the moment, also if it comes to insurance companies, come with an enormous short-term characteristic. Insurance management, therefore, has very often this interesting topic to do long-term business, to be a long-term investor, to actually work with certain schemes in the direction that we just discussed, being aware that actually they have to get a shareholder capital from the rather short-term oriented capital market. That is a conundrum we, at a certain point in time, also have to address if we want to increase, at least on the time scale, the risk-bearing capacity. It's not trivial, because the shareholders that are out there, they obviously have many, many opportunities to allocate their capital. They don't need to go necessarily to the insurance industry. And that's what we actually somehow need to address by making the insurance industry as such also an attractive, let's say, capital market participant, which we all try quite clearly. But we should be aware of this, let's say, kind of limitation. if this was the last instance that I can talk, I also would like to have this great question about whom I'm going to call.
Who would you like to call? You have one
No,
more
I
thing. Christmas is
can
around
finish the
corner.
thing. I don't need to say it now. Yeah, but it's.
No, please, we are all curious. Maybe that's around for everybody. So who would you call? Maybe somehow someone can organize a phone number.
If they're not here already.
Yeah.
The audience is also with us, so who
Yes,
would
yes,
you
yes.
call?
I mean, I would love to call you all, but for sure. But as this is a little bit this kind of Christmas wish type of question, isn't it? I come back to my topic earlier, the price of carbon. I do believe that there are two people who can actually resolve this. Therefore, I would call, let's say, a person in Beijing, the president there, and I would clearly propose, why wouldn't you call, let's say, the other president in Washington? You propose the following thing. We introduce, you and me, we introduce an emission trading scheme. Why do we do this? Because we really want to have a price of carbon. Of course, we want to have a price of carbon. We want to steer the market. And we want to use the emission trading scheme, which is bound, of course, to the emission level that we want to have, to finance a loss and damage and adaptation fund. That's what we want to do. These two people can do this.
So let's talk in COP29 how your phone call went along.
Yeah.
That would be a nice deal.
But you need to
Is
give
that
me
a
the number.
deal?
The number needs to come from you.
No, wonderful. Thank you, Günther. Pamela, I have one last question from the audience to you. And we come back to the data problem debate and the data topic. Is the ISSB a solution to the data problem?
Well, the ISB and any regulatory effort that is being made to collect sustainability disclosures and to actually promote sustainability disclosures, and with that also make people aware that they should act, is a very big part of the solution. As we know, the sun is the best disinfectant. So ISSB, but also the European efforts to have European sustainability reporting standards, if all of these are coherent, I think they're a very big driver to support actually the sustainability transition. But of course, what we also see is that this is not the only solution, because one thing is to report on what you think are material risks, or just avoid reporting on these material risks because you don't think these are material. So there needs also to be due diligence supporting that. So I think what we still see is that reporting about it, the burden is enormous. But we need to know, what does it lead to? And does it then lead to actionable results? Because that was also one of the questions in the preparation of the panel. How much more regulation is needed? We do not need more regulation. Yeah, I think the regulations are going in the right directions. There are maybe differences about materiality aspects, but we need to make sure that this regulatory effort is also being actionable and that we use it. And that, I think, is the status at which we are, that we start selecting based on the information we have, is to say these are, I wouldn't say best practices, but these are the good practices and these are the ones that should be promoted. And that is, I think, ISSB, any disclosure is helping, but we have to go beyond disclosure, because disclosure alone is not solving the problem, and especially if the disclosures are maybe a little bit difficult to interpret.
Thank you. But you also wanted to answer that question, or to bring in your perspective.
No, can I answer the Christmas
The Christmas,
message? Yeah.
it's not a Christmas call.
Yeah,
It's
all right.
it can be a summer call as well. So who would you like to? Thank you, Pamela, by the way. First, thank you, Pamela, for your insights. So who would you call?
I just have to
Last
be
round.
careful because I'm with the UN, so need to be careful about. But I'll use codes, right? So I agree with what Günther said, and so my Frohe Weihnachten message call, Christmas call, is to a certain chancellor to make it happen, to make sure that what Günther said makes it happen. So that's a nod to German efficiency and implementation.
All right, thank you.
For implementation, Germany would be happy to implement.
Well, that's going to be an interesting debate at COP29, ladies and gentlemen.
I
I'm
think
very
so
much
too.
looking forward to it. Who would you call? One last word.
My Christmas wish. So my Christmas wish, or my last wish, or not my last wish, I hope.
I'm still.
my Christmas wish would be, and I think as well, I mean, I fully agree, we don't need more regulation. Let's implement really what is there. Let's use it and use it in the best and efficient way and not putting other layers on top to achieve. I think the tools are there. Let's use them.
I'm very excited and curious how we continue our conversation. Not with a new concept, not with new regulations, but really with reports of doing at the next COP, right? Thank you so much. This is your round of applause to the panelists. Thank you for making the time. And thank you for watching. I know it's been crazily busy days, so thanks again for making time in your calendars. Thank you also, dear audience, from wherever you're joining us, for being here with us in the German Climate Pavilion. I see you soon. Thank you.
Welcome to the German Climate Pavilion at COP28 in Dubai. Ambitious, just together.